This business owner earned nearly $2.8 million. They had a successful company, they had investments, they even had a tax preparer. And yet, due to missed planning opportunities, they may have been leaving tens of thousands of dollars on the table every single year. Not because they did anything wrong, but because their tax structure wasn't fully optimized, year after year. And over time, those small leaks can become very significant numbers. Welcome to Ivy Smart Tax. This is a tax leak case.
Wait. How do you make almost $3 million a year, have professionals helping you, and still potentially miss significant tax opportunities?
Because high income does not automatically mean high-level tax planning. In fact, some of the biggest tax leaks I've seen happen inside otherwise successful businesses. And that's exactly what happened here. Let's look at the client. This is a married couple living in New York. The husband owns an engineering consulting firm taxed as an S-corporation. The wife operates a profitable online education business. Together, they generated approximately $2.78 million of annual income. They also owned a commercial rental property, a short-term rental, investment accounts, and several partnership investments.
So this isn't somebody just starting out.
Not even close. Most people would look at this income and assume the tax planning was fully optimized, but that's not always how it works. One of the first things I review is the effective tax rate. The couple paid approximately $905,000 in total taxes. That's nearly $1 million flowing out the door in a single year. Based on the information available, their overall tax burden appeared significant enough to justify a deeper planning review. Now, before anyone comments, no, a 32% effective rate is not automatically wrong, but it tells us something important.
There's enough tax being paid that it's worth looking deeper?
Exactly. Large tax bills often create large planning opportunities. Then we noticed something interesting. The return showed over $170,000 of state tax payments, but only $10,000 was deductible federally.
Wait. So they paid $170,000 and only got credit for $10,000?
Exactly. Because of the SALT limitation, the state and local tax deduction cap. In simple terms, once you hit the limit, additional state tax payments generally stop creating additional federal deductions.
That hurts.
It can, especially for taxpayers living in high-tax states like New York and California, and that's why this became one of the first areas we reviewed. That's when we asked an important question. Was the pass-through entity tax election being fully utilized? Because the business generated approximately $1.9 million of pass-through income.
Why does that matter?
Because in some situations, the exact same state tax payment can produce a very different federal tax result. If the owner pays state tax personally, much of the deduction may be limited because of the SALT cap. But if the business pays qualifying tax through PTET, the business may receive a federal deduction instead. Same tax, different location.
So the tax is still paid, but the deduction location changes?
Exactly. And in tax planning, sometimes location matters more than amount. After modeling the numbers, we found that improved PTET utilization could potentially reduce federal taxable income significantly. Depending on the facts, the potential benefit could be meaningful enough to justify a complete planning review.
That's one strategy?
One strategy. And we're just getting started.
This is why I tell people taxes feel like a video game with hidden levels.
Except the hidden levels involve real money. Next, we reviewed the rental properties. One property immediately caught our attention. The building was generating rental income. The mortgage balance was still substantial. Yet, during our initial review, the depreciation appeared lower than expected.
What does that usually mean?
Typically, it means one of two things. Either the property had already been heavily depreciated, or some depreciation may have been missed. And those are two very different tax conversations. Sometimes missed depreciation can be recovered without amending years of tax returns. Depending on the facts, certain taxpayers may be able to recover previously missed depreciation through an accounting method change. One possible method is Form 3115.
So there may be a way to catch up on those missed deductions all at once?
Potentially, yes, subject to the applicable rules and proper documentation. And for a business owner, that can turn an overlooked deduction into a planning opportunity. Then we reviewed the home office deduction. The couple appeared to be claiming home office related expenses, but most of the income producing activity was happening through the S corporation. That raised an important question. Were those deductions being claimed in the most efficient location?
Translation, the deduction isn't necessarily wrong. The location might be.
Possibly. And in tax planning, where a deduction is claimed can sometimes matter almost as much as whether it's claimed at all. When we dug deeper, we discovered something interesting. The home office expenses were being deducted directly, but the primary operating business was the S corporation, and that matters.
So the expense itself isn't necessarily the problem?
Correct. The real question is whether the deduction is being captured through the most appropriate structure. For qualifying expenses, one solution that is often evaluated is an accountable plan. Under an accountable plan, the corporation reimburses qualifying business expenses. The corporation receives the deduction, and if the rules are followed, the shareholder generally receives tax-free reimbursement.
So instead of the owner paying personally, the company reimburses the owner?
Exactly. Same expense, potentially cleaner tax treatment and documentation. Next, we reviewed the QBI deduction. The business was already receiving a substantial QBI tax benefit, but high-income taxpayers should never assume that a QBI deduction is fully optimized.
Because the software calculation isn't always the final answer?
Exactly. Many business owners assume that if the tax software calculated it, the result must already be optimal. But that's not always the case. Factors such as income level, compensation structure, and how the business operates can all affect the final outcome. For higher income business owners, even relatively small adjustments can sometimes produce meaningful differences. One of the areas we reviewed was officer compensation. The owner was paying himself approximately $290,000 of W-2 wages. Reasonable compensation must remain reasonable. But there is a legitimate planning question. Are the owner's wages aligned with the actual work being performed, experience, management responsibilities, and industry norms? Because compensation affects payroll taxes, and it can also affect QBI calculations.
So we're not asking, how low can we go? We're asking, what is defensible?
Exactly. That's CPA planning, not TikTok planning. Then we asked a question many business owners never revisit. Is the current entity structure still the best structure?
Even after years of success?
Especially after years of success, because businesses evolve, income changes, goals change, and the structure that worked years ago may not be the most efficient structure today. When we reviewed this client's situation, the facts suggested the structure deserved a fresh review. That doesn't automatically mean a different entity is better, but it does mean the structure deserves a fresh review.
So the question isn't, what's the lowest tax rate?
Exactly. The real question is, how will the profits be used? If most of the earnings are distributed every year, one answer may make sense. If substantial earnings remain inside the business for future growth or investment, the analysis may look very different. That's why entity planning isn't about chasing tax rates. It's about making sure the structure still matches the business owner's goals. Then we reviewed the investment portfolio, and another pattern appeared. There was a substantial amount of interest income, relatively modest dividend income, and limited capital gain activity.
What does that tell you?
It may suggest a more conservative investment approach, and there's nothing inherently wrong with that. But it does raise planning questions, because two people can earn the same amount of investment income and end up with very different tax results.
So we're not changing investments because of taxes.
Exactly. Investment goals should always come first. But understanding the tax consequences of different types of investment income is important, because it's not just about how much you earn, it's also about how you earn it. Now, to be clear, we're not saying every one of these opportunities would apply to this client, and we're not saying every strategy would necessarily create tax savings. Some may produce little or no benefit after further analysis. But when we stepped back and looked at the return as a whole, one thing became increasingly clear. The potential impact was no longer measured in hundreds of dollars. Depending on the facts, the cumulative effect of multiple planning opportunities could become substantial over time. By themselves, none of those changes may seem dramatic. But when multiple opportunities exist at the same time, that's when meaningful results begin to appear. That's what sophisticated tax planning often looks like. Not one magic deduction, not one secret loophole, but multiple smart decisions working together over time.
So this isn't one magic strategy.
Exactly. And that's how major tax leaks are often created. Not from one big mistake, but from multiple missed opportunities repeated year after year. And this is the question that always stays with me. How long has this been happening? Because tax leaks rarely get noticed. The money doesn't disappear all at once. It disappears little by little. And over time, those small leaks can turn into very large numbers.
At that point, it's not just a tax leak anymore. That could be a second retirement account or a college fund.
Exactly. And that's why proactive tax planning matters. Because small annual tax leaks have a way of becoming surprisingly expensive when they're repeated year after year. The good news? Once you find the leak, you can start fixing the leak. This client wasn't doing anything wrong. The issue wasn't compliance. The issue was optimization. And that's where some of the biggest opportunities often exist. If a household earning nearly $2.8 million per year can still have multiple tax leaks, then here's the question. Could similar opportunities exist in your return? Follow Ivy Smart Tax. I'll continue sharing real-world tax cases, tax planning insights, and some of the most commonly overlooked tax leaks, so you can find the leak, fix the leak, and keep more of the money you've worked so hard to earn.
Because the most expensive tax mistake is rarely the one you already know about. It's usually the one you don't even realize you're making.
This case study is provided for educational purposes only. The facts, figures, locations, businesses, and taxpayer details have been modified for educational presentation. Tax outcomes depend on individual facts and circumstances. The strategies discussed may not apply to every taxpayer. Before implementing any tax strategy, consult with a qualified tax professional regarding your specific situation.